You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob, and Merry Christmas.
And good to be with you, and a Merry Christmas, too. We're not afraid of using politically incorrect terms.
Oh, well, I'm on the air with you, Bob. That's politically incorrect already. Base metals, crude oil, and precious metals, a little life?
A little life, yeah. There's certain seasonal pressures in the financial markets and in the commodity markets, so we play them. And so, last year we had the rotation out of about this time, and the rally in these depressed sectors, base metals and crude oil and whatnot, gold sector, rallied up to around May, and the different items in there did become overbought, and we exited the trade. And then in the fall, we were looking for the main guidance on base metals would have been copper, and it has a tendency to have a seasonal low in around November. It did have it around $2, and has been sort of recovering and building a base kind of thing. And then you can also have a seasonal low for crude oil sometime in December or maybe into January. And it came down until recently and became oversold. And we were looking for at the base, it did for a week or so, and then getting above 37.50 would be a pretty important breakout, and it's got above there yesterday, and it's holding above there today, which is constructive. And so one would expect to see crude oil itself continue to work its way towards a rally. The oil patch stocks would, of course, go with that. And so we could have some sunshine in the oil patch maybe into February. And similarly with the base metal side and the base metal miners. Some of these have bounced quite sharply already. And then without really doing any seasonality on it, with gold and the gold shares down to depressed levels. And they can work their way up here for a while. Some of them, when I've been in myself here, has sort of gone from 50 cents up to 70 cents in 2 weeks, which is kind of nice. And so let's mark this sector as positive, and this would not have anything to do with the so-called Santa Claus rally. Although the other day when I was watching the tape, I saw the stock symbol, HO going by, which is often the signal of the start of the Santa Claus rally. And I don't know how far this is going to go. This time of year, one of our favorite trades has been to get long small caps about the middle of December and short big caps, and there's always usually a play where small caps outperform into the first week in August, and I think that might be working. It's too late to put the trade on now, but it's been something else that is a sector that can turn positive, so to speak, with the Russell 2000, the RUT. And over in Bondland, what's going on over there? They had a couple of setbacks in the stock market, and the rallies in the long bond, the TLT, were modest. And we had the big top for the bond market, long-dated treasuries, long-dated Government of Canada bonds, back in January, February, and called it ending action, and there's been a a series of lower highs in price ever since on treasuries. If the treasury bond market rolls over in here, this would be serious. But there is some evidence to suggest that it could roll over. You've had the hot action in low-grade bonds like junk peak out in June of 2014. And that, if you look at the CCC-rated junk, was about 8%, and now it's up to 18%, which is a huge increase. So anybody holding lower grade instruments, either fixed income or preferred shares, the price has been unkind. And with this, you've had, the widening of credit spreads, which became particularly helpful in June this year, when they reversed and started to widen, and we had some benchmarks there that through July, if you broke out above some previous levels, it would be a serious move in widening credit spreads, which would push stock markets down. So that was accomplished by late July, and then of course you had the high in the Shanghai market. I think it was early August, and then boom, down it went, something like 35%, and it took commodity prices with it, put some pressure into major global markets stock markets around the world. So, and then you've had a very nice rebound out of that pressures down into August, the bounce back into September, and the rebound in the Dow Jones, for example, can't remember exactly what the numbers were, but we were on the high side target. The rally did exceed it by 100 points on the Dow, which, 17,000, it's pretty good. And now it's somewhat vulnerable heading down. But so let's look at our rotation in the equity sector. The financials, the bank stocks and broker-dealer stocks are vulnerable because they sort of have remained somewhat elevated. And the material resource sector got very depressed. It's moved up a little bit. That can rally for a while. So we're going to get, I think, a nice trade out of that one. But on all of these moves, you have to take some money off the table when it's strong and put some money to work when they're very weak. And this is where reliable and tested technical measures have been very helpful for us. Like, for example, when crude oil was plunging, you kept looking at it saying, hey, when do we get the buy on this? And when you get a plunge like that down to the 35 level, it's sort of like the phrase is falling, like trying to catch a falling knife. It can be very painful. So this is where we then stand by on our technical research, and it got down to technically positive or technically opportunistic for us. And the key was to get it to go above 37.50. It has done that, so it's looking good. And this gets us over into the precious metal sector, which, it became depressed, very depressed. And we favor the stock side because playing the metals themselves, what you're effectively doing is just trading currency. And if the U.S. dollar is going to remain in a positive or firm market, there's not much money to be made in the price change in gold. The price change may be modest. And of course, silver is always dangerous to play because when you're in risky credit markets, the gold-silver ratio acts like a credit spread, and it'll go against silver. And this is where silver, dropped down into the low 13 and a quarter, and under, it was just very, very difficult times. And yet, was watching publications by the gold and silver bugs, and particularly the silver bugs, and they had wonderful fundamentals. But if you look back on it, the supply-demand analysis on silver is every year there's always a shortage of silver, which to the silver bug says it's going to drive silver to the moon. And but I think I wrote last week that silver at 13 and a quarter. Can you imagine how bad it would have been if the fundamentals hadn't have been so positive? It's ironical. So anyways, the problem in silver over the longer term is that when you're in problems in the credit markets, silver is actually a guide to that. Like if you have a sudden drop in the price of silver relative to gold, often that'll forecast a pending problem in the credit market. So let's just call the gold-silver ratio the metallic credit spread. So we like the gold stocks. We think they can rally through into February, and we'll see how far they actually go.
We'll have more with Bob Hoye right after the break.
See singing impressionist Andre Philippe Gagnon.
And I think to myself.
In Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com. Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, we have a question from Chris Barsky. He wants to know if a central bank like the Fed can ever go broke, be declared insolvent and liquidated, or can they always print their way out of bankruptcy?
Well, that's a good question, Chris, and it pops into mind as an amusing response, and that you could say that the U.S. Central Bank has been in default since it went off the gold standard, formally went off gold in 1971. And this has always been the measure of a central bank, as if it runs out of the reserve, and traditionally the reserve was gold, it then stopped payment, defaulted, whatever you want to call it. So the Federal Reserve did stop payment in 1971, and that would hold for any other central bank that would not meet its obligations in gold. So it's always been a cheat, going back to England when it was the financial center of the world, and in 1797 there was a severe financial crisis, and there was a scare went through the markets that Napoleon was going to invade, and the demand for gold was such that it sucked huge amounts of gold out of the Bank of England, and they shut the gold window, and that was that. So then they were off of a gold standard until 1819, when much of the war risks and invasion, well, the invasion risk was never ever real, but anyway, so they went back on gold. So in answer to the question, yes, they've been in default since going off the gold standard, but now you've got a strange situation here where there is no reserve of any kind, and they are highly leveraged in the bond market. So if bond prices, and they have been, at least the Fed, that's been buying, they were buying some mortgage-backed bonds and all sorts of bad stuff like that. But yeah, if the price of bonds goes down, and we think that it's probable that next year you would see an even more severe rout in lower grade bond prices, and probably a decline in high grade bond prices, there could be a bond revulsion whereby the public and many funds just say, hey, no more. So it's fascinating to consider that, yes, some sort of even worse default for the central banks is possible, and it would be worse than just stopping payment on gold. They may just actually get the big margin call. And we know that in any contraction in stocks and bond prices, that speculators get forced out because of the margin clerks. So where you've got a central bank pushing credit out the window during a speculative market, the margin clerk's always sitting there waiting for when the prices come down. And when they come down enough, then the margin clerk has the power, and the central bank has no power any further. So, yes, it's a delight to think about. It's possible that there be a different kind of bankruptcy for the central banks that have been extremely reckless.
Now, of course, can you compare the U.S. situation to, say, a country like Argentina, where financial crises happen all the time?
Oh, yeah. No, I prefer to stay in senior economies. Banana republics, they've been blowing up for centuries. But this would be in senior economies where all the central bankers have taken the same courses and do the same knee-jerk things. And yet a good many fund managers and businessmen think that the central banks run things. But if you look at the whole sweep of history, they're always there in responding to market forces rather than creating market forces. But I'll give them some recognition here for stepping out of the bounds for a while, is that the drive down to, in Germany, almost zero interest rates for 10-year notes was exceptional. That has never ever happened before, but that has been exceptional speculation, and the distortions put on by that have yet to be corrected. And when the correction comes in, it'll be phenomenal.
Bob, thank you very much for chatting with us. I hope Santa Claus brings a big sack full down the chimney for you.
I think so. I hope so too. And going to wish you and yours all the best for the season, and our listeners a very happy and prosperous new year.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. Merry Christmas, everybody. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.